Good evening, everybody. How are you doing? This is Seth Martin, and this is the Middle Class Investor. Well, we're looking at a chart of the S&P 500, and we had a down week. For those of you who watched the video last week, we talked about a pullback, and we got a pullback. Just there wasn't much to it. Let's zoom in here and look at it a little closer. Just trying to get the numbers on there too, but we don't need that for now. So, you can kind of see this little zigzaggy pattern. This is pretty typical of a pullback, when you get a kind of an ABC. So you can see an ABC, then you see an A, B, and then we had C up here to here, and then we pull back to here. You can't really tell here, but there's an ABC here, like so. And then we've already started moving up. So again, this is all kind of compressed. We really probably ought to look at, let's look at a daily. That might be better. This is all kind of compressed because, we're getting to the very end of the trend. And so the patterns are more compressed because the degree of trend is smaller. So that's what we're dealing with here. But let me see if I can do it on there. So you can see kind of the A, B, C, and then we got an A, B, C really went up to here, I guess. And then we've got an A, B, C, and then we've got the A portion of this. So A, we'll get a little pullback early next week. It may come all the way to the line, it might not, and then boom, out to the races. So actually, this pullback, I didn't draw it right here. This is probably A. We'll get a small B to like right here, and then a C up to about just under here somewhere, and then a pullback to just below this low, and then off to the races. So somewhere in here, if you want to try to catch this last move, and I do believe it's the last move, you want to try to catch it in here somewhere. We'll look at the chart to see where that is, but in fact, let's just do that now. So the range I'm talking about, if you want to, in fact, you could, if it opened right here where it is, so the S&P 500 closed at 2381.73, you could actually buy right there, and that would be an okay place to buy. Although, it's likely going to pull back here to 2360. So if you want to wait for a 20-point lower pullback, 15 to 20 point lower pullback, then you can help your price position. But really anywhere in here, because we're going to get probably, well, what is this, from, let's call it 2340 up to let's call it 2450 at least, maybe higher, but let's just say 2450. So you're talking about a 120 point move, or roughly what is that? That's 1% would be 24. So it's about a 5 or 6% move, something like that. In fact, let's just measure it, so we're not guessing. So let's say you bought here at 2367. So 2367 up to, call it right here, is about 4%, about a 4% move. So if you want to try to get that last 4%, you want to try to buy right in here somewhere and let it run up here to the high. Now I'm going to look at the Dow, because the Dow really is a little bit better chart. The S&P is always good to look at because it's so much more diversified. than the Dow. But for the purpose of seeing this pattern, let's look at the Dow. See if I can get the whole thing in here. Yeah, I think I zoomed in too far. Let me zoom back out. Try this. Let me just try it like this, and then zoom in from here. That's probably better. So let's, yeah, right about there. Okay, so you can kind of see the zigzagginess of the pullback. You know, kind of an A, B, C, and then we had A, B, C, and then A, B, C. I mean, this is just the way it goes. I know it's not pretty, but, and here's A, you'll get a little pullback next week to there, and then a C up to about there, and then a pullback to just below this little low right here, and then boom, off to the races. And we're probably going to break. Might not go that high. We might get to 21,750, and we're talking about this happening around the first part of July, maybe the second week in July. So just be careful, don't get greedy, because once these little waves of degrees of trend, once they kind of play out, we're going to immediately move into the larger degree downtrend, which you know, all of a sudden moves bigger. It's kind of like, think of it like back in during this time frame. Here, let me back out again. Let's go back to a weekly chart, and let's go back to the S&P 500. So I want you to recall these moves here, this up down up, or this down up down. These were significant moves. So we're talking about capturing 4% on the upside, but this can happen really, really fast. So let's go back to a daily and just capture those moves. So from high to low here on this first move down was what was that? That was 12.3%. Okay. So that's, you know, capturing 4 and risking 12.3, or in this case 14.5% on this move here. You know, that's a fairly risky proposition. You better be paying attention so that you can react quickly if you need to. All right, let's look at the VIX real quick. The VIX obviously took off this week. I say obviously, may not be that obvious if you don't follow this kind of stuff regularly. But it shot up really high on this downtrend, and then as quickly as it shot up, it's pulled right back. So, you know, what you want to look for on the VIX is the range. So you can see all through here the range was pretty narrow. Now the range is starting to expand, which means the volatility is probably starting to increase, and option prices are going to get more expensive, and so on and so forth, if you're interested in any of that. Let's look at bonds. Let's look at the 10-year. The 10-year, I don't think is quite through pulling back. We've covered this before. Let me go to weekly. Keep switching to a daily to show certain things, and then I'm missing the weekly. But we had this big move down, which culminated in a new low back in mid-2016. We had a run up, pretty aggressive run up, and now we're in the middle of a pullback. So using that kind of ABC strategy, you can see here that, let's zoom in a little bit. You can see here that we pulled back in an ABC, B, and I don't think C's finished. A lot of times the C ends up being a kind of a 1, 2, 3, 4, 5. So we'll probably close this gap is my guess, and this'll, it won't close down here, but you'll probably get something like, you know, maybe it might gap down next week or the week after, like so, and then actually run lower, like down below here, and then quickly rally back up. So you get what we call a hammer. So if the following week we get a hammer like this, you know, that usually signals the end of a downtrend, this being the downtrend right through here. So if we get a pattern like this, boy, you need to run to your accounts and get rid of your bond funds, in my opinion. You do what you want to do. It's your money, but if you're in bond funds, this move could be pretty substantial. And what I'll do is I'll show you kind of a wave 3 move in another market, so you can kind of get an idea of what it looks like. In fact, let's switch over right now to the dollar, and well, I can't show you the dollar index. Well, I can show you. Let's look at oil. Let's look at oil real quick. So let me back up over this and do /CL. This right here. Let's look at it. Yeah, I guess we have to look at that. But you can see here this. So let me zoom in on this so we can get the effect of. So this would be equivalent to our low in the bond market. So we ran. Let's back up. So we ran up to this high, and then this would be kind of our first move down, and then this would be the first pullback. You can see it's kind of zigzaggy, A, B, C, you know, or something like that. A, B, C, C kind of thing. So this would be our first pullback, and then this right here. So let's highlight this. So it looks pretty harmless right here, right? But let's highlight this with a little oval. Okay. So that's the part we want to look at. We're going to zoom out and look at here in a second. This is a wave 3. So it went from roughly $108, almost $109 down to $45 in, let's see, from mid-June in 6 months. 7 months. Let's call it 7 months. So in 7 months, oil was cutting in half, more than half. It went from $109 to $45. So if you get a move like this in the bond market, it's just it'll wipe you out. There just won't be anything left in your bond funds. So don't let that happen. The risk of this wave 3 happening is substantial right now. I just can't stress that enough. So, you know, ideally, if you want to try to time it perfectly, just pick some point inside this box to sell, because what we're looking for is a pretty strong move up this way, rolling out. And how far could it go? Well, it probably won't even stop until you get to this 3.1. But from let's call it 2.2, from 2.2 to 3.1 in your bond fund is going to cost you about a 30%, well, about a 15% loss. So it's not even going to slow down until you get to there, and even then it might just blow right through that. You know, you might see, let's back out a little bit. Let's look at a 20-year. Yeah, so we're not even going to slow down until we get to here. We might pull back a little bit, and then you're talking about maybe getting up here to 5 and 6 pretty quick. So this kind of move from 2.2 to 6 is just going to wipe you out on your bond funds. So I'm sounding the alarm. It's ring, 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 you know, on the alarm here. All right, so let's close that, open this, and look at the short term, the 13-week Treasury. And let me go back to a 5-year. So it's interesting that they're starting to talk Fed again. What's the Fed going to do? Well, I'm going to tell you right now, the Fed's going to raise rates. That's what's going to happen. They don't want to be too far behind this bond market, and as you can see, it is really starting to rally, starting to get up ahead of steam. I mean, this right here, what is this angle here? That's like a 70-degree angle on this move. So definitely the Fed will raise rates in June. That might start some sort of sell-off. I'm not sure. There seems to be a lot of people thinking that, oh, the economy's not as good as we thought it was. Maybe the Fed shouldn't raise rates, and there's all this talk. But I'm going to tell you right now, they're going to raise rates because this bond market is moving out with or without the Fed. And the Fed, one of their primary goals is to appear as if they're in control of the economy. Even though they're not, that's one of the things they want to do. They want to try to appear like they are. So look for a rate increase next month in June when the Fed meets in June. Let's look at some of these countries. Germany is probably going to continue. It's already made a new high, but we got this decision point up here. It's probably on its way to that. Japan has made it to its decision point. Might chop around here for a little while. Might even shoot up and make one last gasp here. But then probably the next stop for Japan is down here around this 39 area, this 40 area. Let's just put a box right there. That's probably the next stop for Japan. This is going to roll over, head down this way. The UK looks strong to me. The UK still hasn't made a new high yet, so I would look for the UK. I know we were talking about the UK maybe leading the market down, but I don't know. Ever since really back in here somewhere, the UK looks stronger to me. It looks like it actually might be the strongest place in the whole global market, at least right now. So look for the UK to continue to move up into this area off of this pivot high right here. All right, let's switch over to toss charts and look at, let's see if the dollar comes up. Nah, it's not going to come up. All right, well, let's look at, I'll tell you what we could do to look at the dollar. I pulled it up earlier. Let's switch over here to this Elliott Wave financial forecast and zoom in on the dollar here. So first of all, let me get the big picture. So the big picture is, this was a 1, this was a 2. This is a wave 3. This is what I'm talking about happening in the bond market. So this is how rapidly it can move. So here we have a 1, 2, 3, and this was all 4, and then we've had 5 up, and we've broken the trend line. So according to these guys, and they're pretty good, the dollar has topped. So what I kind of alluded to this last time. What I'm going to be looking for, and maybe this goes a little lower, I don't know, but what I'm going to be looking for is this to kind of rally up into the underside of this trend line. So if you extend this trend line out a little bit, we should get some sort of rally back into this area, and then what you want to do is be long. You could be long the euro US dollar. You could be long the British pound US dollar. Personally, I like the British pound US dollar. And I talked about that. It was either last week or the week before. But the euro has gone down quite a bit. And so I think that's also a good trade. And so the way we've been looking at those, I'll just bring them up here for you real quick. Let me go back to the profit charts. For the euro US dollar spot, you can look at, that's the euro US dollar. Where's the ETF? I had an ETF on here somewhere. Well, what you could lose, you could do let's see, the UUP is is for the dollar up, and then it's I forgot what the dollar down is, but there's an ETF for the dollar down. There's also, maybe for the euro, it's EUR. No, I can't remember the symbol for the dollar, but we also pulled up this one for the British pound, which is right here, I think, FXB for the British pound. So what we should see on the British pound, it's probably going to go up a little bit higher first. I would say probably into this area right here off of this pivot here. So I would look for the British pound to move into this area here, and then pull back. Okay, so once any market starts to get extended, there's usually some sort of pullback, and the pullback will take the form of something like this. Okay, and it might actually retest this trend line here or get close to it. Another way to kind of pick a target. So once it starts pulling back, you got to pay real close attention if you want to get a good price. But another way to pick a target is you come to the low here on a Fibonacci, and let's say the high goes to right there. We're going to kind of guess. You could look for a 62% retracement, which is this line right here. So maybe it does come back to this line here, but out here somewhere in September or something. But probably not. Probably in July with the other markets. So I would look for this to pull back about $4 or $5 from here, and then look to enter, and again that would be a wave 3. So it should be a pretty good move. Probably would take you all the way back up here to 170 before it even really started slowing down. So these are real good trades when you get to what's called an important low. So the way you kind of look at that is you go to like a monthly chart. I'm jumping around here a little bit, but if you go to a monthly chart and where's the major pivot? Well, there's a major pivot right here. So if we come to, these are all important pivot. These are all pivots here, but can you see that this is a major one? It came down and really just chopped sideways after that pivot. So this is the most important pivot here. So what you want to do is kind of come over here, and just below this low, you want to create a box, and that's about where the British pound stopped going down. So this is if you go to the next high or the lower time frame, which would be weekly, anywhere in here, you could literally get in here and it would be okay, but well, let me take this off first. I'm jumping around. I apologize. Jumping all over the place here. Let me take the Fibonacci off. Because it's just too cluttered. And then we'll do this like so. So you can see here's the low right here. So what do we want to look for? We want to look for a week that closes above the high of the low week. So that's basically this line right here. So this would have been an entry right here. So what you could do, and most likely this is going to pull all the way up to here, but you could do is wait for it to come back to this line or even just below this line and buy. Excuse me. Then let's say it takes off but then fails and goes below this line. Well, then you exit the trade, right? Because it could actually go down and make a new low. But it's likely to bounce here because we have a low, a lower low, and then we started making higher highs here. So this is likely to hold up. Also, given this is a good support area based on the higher time frame. So to me, if you just look for pullback on the FXB somewhere in here, this is going to be a great multi-year trade / investment. Like I said, you're probably, let's see if we can, you're probably looking over the next year or so, year or two, to at least get back up up to, let's draw a line here, these previous highs here. So real conservatively, if you wanted to exit the trade like at 170, so let's say you enter at 124 and exit at 170, that's a pretty good trade, pretty good investment for 2 years. It's a great opportunity. You don't get many of these, so you got to take advantage of them when they come. Excuse me. Okay, let's go back to these charts. I'm jumping around a lot. I apologize, but I'm trying to be swift. Let's look at the British pound first, since we were talking about the British pound. Let me go to a weekly chart, and I think it'll be obvious here. You can see that, you got kind of this zigzag move here. If I could pull up more time frame, I can pull up monthly. Nope. Can't pull up a larger time frame, but to me this looks very what's the word? Corrective. I mean, this looks like a wave 5 here. I mean, I can't see what was before this, but this was probably a wave 5, and then this is like an A, B, C, or A, B, C. Maybe this is the first. Maybe this is the first move off the bottom, and we're just entering into a wave 3. So I don't know, but to me, when I look at this chart for the British pound, I see a move long term, so multi-year, into this area right here. So over the next couple of years, British pound, and it may be sooner, it's going to make its way up into this area around 200, 210. And then we'll get a little pullback and then a big rally. So British pound is going to be going up for a while. That's what I see. That's my opinion. Now let's look at the euro US dollar. So we looked at the dollar a minute ago, and so what I'm, for those of you that are wanting to be long the euro, first of all, I was anticipating this would roll over and make another low, because it didn't look like this wave 5 was long enough for this triangle, but it kind of just didn't want to go lower. So once we broke this trend line here, this first trend line in yellow, once that was, I was looking for that to retest and then go lower, but once that got broken, that thesis is no longer valid, and we confirmed that by looking at the dollar. So to me, the next stop potentially in the euro is probably this trend line, this area here around 1.16, and then some sort of pullback. It could either to the trend line, or it could be lower. It could be something kind of like that. And then we're probably gonna see this take off substantially as the dollar falls. So I don't know. To me, the next 10, 20 years is going to be a tough time for the United States, mainly just because there's a lot of deleveraging that's going to happen, and then you also got the added not bonus, but the added aggravation of the rest of the world's standard of living is coming up, and ours kind of has to come down because the way the dollar is positioned in the world really favors the U.S. at the expense of some of these other countries, and I suspect that that's going to equalize or normalize in some way that lowers our standard of living collectively. Now, I'm not talking about you personally listening to this program, but as a group, as a people, as a collective group of people, our standard of living is going to go down. In fact, it's already gone down. It's been going down since 2000. Some of you may feel it. You may actually feel like you're poorer than you were when Clinton left office, and that's not a mistake. I mean, that's happening because, the destruction of our money, the massive debt that we have, the inflation of these bubbles. It's all somehow, some way, it ends up costing the average person money. not money per se, but standard of living, either in the form of they can't get certain jobs or their money doesn't go as far as it used to, those types of things. So anyway, the last thing I wanted to look at is I pulled up my NinjaTrader charts, and I wanted to look at the, sorry about this so bright, I wanted to look at the NASDAQ, because the wave pattern on the NASDAQ is really good. So, this was the low back here that started this trend up. This was the wave 4 low. And then we've kind of got a 1, 2, 1, 2, 3, 4, 5, 4, 5, 4, 5. So there's like 3 degrees of trend here. And you can see, of course, after wave 3 and 4, then we get a 5. So the target here, the typical, what Steve Griffiths marks as the typical wave 5, is right here in pink. So you can kind of see the NASDAQ's already kind of pulled up there. So this would be an impulse wave, so it would move in fives. So you'd have, it's already kind of made the wave 1 move. We should get a really strong move in a wave 3, and then another pullback, small though, and then a wave 5, and then something like that really quickly, some sort of retrace like so, and then down to about there. So, by July or August, the NASDAQ could be, pretty close to 5,000. We could have lost 600-700 points on the NASDAQ. So, again, this can all happen very quickly. Let's just talk about the psychology of this a little bit. We make all-time new highs. I mean, it's all over the news. It's all over the news here. Well, it's all over the news the day it breaks. Then it's all over the news every day until it pulls back. And then as it starts to go again, it's all over the news again. All-time highs, all-time highs. How far can the NASDAQ go? Blah, blah, blah. And then boom, you get this kind of deal. Oh, wow. Oh, that's pretty significant, And then it starts to come back, and people are like, whew, thank goodness, this was scary or whatever. And then about the time people start feeling good, like, okay, that looks like the trend is resuming, people start piling back in, then you get one of these deals. And this right here tends to kind of deflate people because they feel like they got fooled here, and then they felt better, and then they got fooled again. And so these are psychologically, these are very difficult kinds of things to undergo. And then after your big wave 3 like this, you usually get some sort of pullback in a 4, and the 4 could come all the way up here, or it could be about the same size as the 2, or even smaller. I mean, 4s, you never know how they're going to turn out. And then you get another low like this, and then you'll come up in another one of these, so another ABC this way, and then the next degree of trend will start, and it'll be bigger. It'll be much larger than this one, and it'll just keep going like that, day after day, week after week, month after month, during the bear market, until people are just sick and tired of selling, and then one day it'll bottom, and that'll be that. So, and we've done this on this program before. We've gone back and we've looked at, like the last bear market. Let me close this down. If we go back and look at the last bear market, let's look at it on the S&P 500, and let's look at a 10-year. Let's look at a weekly, and let's look at a daily. So, well, we got to go back a little further. 20-year daily. So this doesn't look like much of a, this was the 2008 financial crisis right through here. And now it doesn't look like that big a deal. You're right. You're looking at that going, that was nothing. Look at all the money we've made. But this was substantial. I mean, you can, if you go back and look at this on a daily chart, let's see if I can kind of pick out. So here's kind of your 1, 2, 3, 4, 5, and then here's your ABC, and then the next degree of trend. See how this is longer than this one, and this is just the 3. So here's 4 and 5, and then you get a larger degree 2. Okay, so this is from here to here now is a larger degree 2. So here's the first 2 right here. Let me do this. Let's see if I can get all this on one page here. So here's your first 2 right here. Okay, and then your 3, and then here's a 2 here for this trend, right? And this is 3, 4, 5. So here's the whole first degree end right here. Okay, and then this is the next 2 right here of the next larger degree. Okay, so let's keep an eye on that, and then let's scroll forward again. So this is all 3. All this right here is 3. All the way down to here. And then you get a new low, because that was 4 and 5. And this was the March 9th low. So that was, I don't know, 5 degrees of trend that sold off right here and bottomed out on this. So we went from, that's on the SPY. We should have done the index. Index would have been better. But so let's just look at it from high to low. What was that? Let's call it 1560 down to 700. I mean, you cut in half, or more than cut in half. So these drops can be dramatic, and the rallies up can make you feel like, oh, thank God, it's all over, and then about the time you're thinking that, then you get whacked again. So just the best thing you can do in an approaching bear market, it's like a freight train coming down the road. Just step off the tracks. Just let the train go by. If you're more skilled, or you feel comfortable taking some risk, you can take advantage of the downside with something like the SDS. Now this is an ugly chart, but you can see that theoretically you can buy in here just about anywhere, and right around here, $12, $13, and this thing, it's going to go to 25 or 26 before you can say go. I mean, it's just going to be rapidly moving this direction. So anyway, there's opportunities there. We'll talk about some of that later. I don't want to get the cart before the horse. Mainly, I want you to be careful and not lose money in your bond funds. I think that's where the largest risk is right now for retail investors. Also, the other thing to say, I think probably for the next 5 to 10 years, maybe even longer, there's a lot of talk about passive investing right now. Oh, just buy the S&P 500. How can you go wrong? If you look at the S&P 500 and you've just been, let's look at the last 10 years, and you've just been passively investing. In other words, you bought the SPY and you just let it rip. Okay, you would have made like 200 and something %, and people are saying, "Oh, that's the way to go." They're even starting to make laws now where the brokerage companies have to provide you like an automated broker. So the problem though is, about the time people think this is the best way to go, that's when things turn around and flip the other way. So the next 10 or 15 years maybe are going to be more for the active investors. The active investors are going to outperform the passive investors. And this is the way the market works. About the time everybody figures something out, they all jump on it, and then the market flips and dumps everybody in the water. So it's just kind of an interesting way, the way the market works. Anyway, that's it for this week. So I'm gonna let you guys go here and call it quits for the week, and we will be here next week. Thanks for coming in. Have a great weekend, everybody. Hope everybody had a happy Mother's Day, too. Bye-bye.